Mezzanine and unitranche debt. Mezzanine debt and unitranche debt are specialized financing instruments that occupy important positions within the private debt market. These structures provide borrowers with flexible financing solutions while offering investors opportunities to earn attractive risk-adjusted returns. As private credit markets have expanded, mezzanine and unitranche financing have become increasingly popular in leveraged buyouts, acquisitions, growth financing, recapitalizations, and corporate restructuring transactions. Both instruments bridge financing gaps that may exist between traditional senior debt and equity capital. Understanding their structural characteristics, valuation considerations, risk exposures, and expected returns is essential for investors evaluating private debt opportunities as part of a diversified portfolio strategy. Mezzanine debt is a subordinated financing instrument positioned between senior secured debt and common equity within a company's capital structure. Because mezzanine lenders rank below senior creditors in the event of default but ahead of equity holders, they assume greater risk than senior debt investors. To compensate for this additional risk, mezzanine debt typically offers higher interest rates and potentially includes equity participation features such as warrants or conversion rights. These characteristics allow investors to benefit from both contractual income and potential upside if the borrower performs well. Mezzanine financing is frequently used when companies require additional capital but wish to minimize equity dilution or supplement existing senior financing arrangements. Several structural characteristics distinguish mezzanine debt from senior secured loans. Mezzanine instruments generally carry fixed coupon rates rather than floating rates, resulting in predictable cash flow streams for investors. They often have longer maturities and fewer restrictive covenants than senior debt, providing borrowers with greater operational flexibility. Unlike many senior loans, mezzanine debt is usually not prepayable without penalty, allowing investors to secure expected income over a longer period. The subordinated position within the capital structure exposes investors to higher credit risk, but the enhanced yields and potential equity participation are designed to compensate for this additional uncertainty. Consequently, mezzanine debt occupies an intermediate position between traditional debt and equity financing. Unitranche debt has emerged as an innovative financing solution that combines elements of senior and subordinated debt into a single lending facility. Rather than requiring borrowers to negotiate multiple layers of financing with different lenders, unitranche structures provide a unified loan package with one interest rate, one set of covenants, and a streamlined documentation process. This simplicity offers significant advantages to borrowers by reducing transaction complexity, accelerating execution, and lowering administrative costs. For investors, unitranche debt provides exposure to a blended risk-return profile that incorporates features of both senior secured lending and subordinated financing. The structure has become particularly popular in middle-market private equity transactions. From the borrower's perspective, unitranche financing offers operational efficiency and certainty of execution. Companies benefit from dealing with a single lender or lending group rather than coordinating among multiple creditor classes. The simplified capital structure facilitates acquisitions, growth initiatives, and recapitalizations by providing flexible financing tailored to transaction requirements. Investors participating in unitranche loans generally receive yields higher than those associated with traditional senior secured debt because they assume a broader range of credit risk. The blended structure allows lenders to earn attractive returns while maintaining strong creditor protections through negotiated covenants, collateral arrangements, and ongoing borrower monitoring throughout the life of the loan. Private debt profiles, valuation, risk, and return. Valuation of private debt investments requires careful analysis of borrower fundamentals, cash flow generation, capital structure positioning, and credit quality. Because private debt securities are not actively traded, investors cannot rely on continuous market pricing to determine value. Instead, valuation often involves assessing expected future cash flows and discounting them using rates that reflect prevailing credit risks. Analysts evaluate leverage levels, earning stability, liquidity profiles, debt service coverage, collateral quality, and industry conditions. Relative value assessments may also incorporate comparisons with public debt markets. Accurate valuation is particularly important because private debt investments often involve long holding periods, limited liquidity, and significant exposure to borrower-specific risks. Private debt risk profiles differ in several important ways from those of traditional public fixed-income securities. Many private borrowers are smaller, younger, or more highly leveraged than issuers in public debt markets, resulting in elevated credit risk. Investors face additional challenges due to limited liquidity, less transparent pricing, and legal structures that may not have been tested extensively during periods of financial distress. While private debt instruments often benefit from stronger covenant protections and collateral arrangements, these features do not eliminate default risk. Consequently, investors must carefully evaluate borrower quality, management effectiveness, industry dynamics, and economic conditions when assessing potential investments within private credit portfolios. The risk-return characteristics of private debt reflect compensation for accepting illiquidity, complexity, and elevated credit exposure. Mezzanine debt typically offers higher expected returns because of its subordinated position and potential equity participation features. Unitranche financing provides a balanced risk-return profile through blended exposure to senior and subordinated debt characteristics. More broadly, private debt has attracted significant investor interest due to its ability to generate income, diversify portfolios, and potentially outperform traditional fixed-income investments. Successful private debt investing requires disciplined credit analysis, thorough due diligence, careful valuation, and ongoing monitoring. By understanding the structural features, risks, and return drivers of mezzanine and unitranche debt, investors can make more informed strategic asset allocation decisions.